Hello, welcome back. So in today's video, I'll be talking about United Healthcare stock and whether or not it is a good buy going into earnings. So for reference, this is my portfolio. So I own quite a fair bit of United Health. I own around 4.7% of my entire portfolio in United Health. And it is actually one of the companies that's been dropping by quite a fair bit this year. So for United Health year to date, it's down around 44%. It is currently trading at an 11 times P multiple with a dividend yield of around 3%, and it's near its 52-week low as well. So before its earnings, United Health closed at near to all-time highs. It closed at around $600, and immediately after that, when it dropped its first earnings, it dropped around 22%, down to around $440. And then at this stage here, the CEO actually resigned. And then the stock dropped by even more, and there were some fraud claims as well coming in on consecutive days, which led to the stock falling more than 60% from this point before earnings. So for United Health, this is the current situation for the company. So the company is facing fraud claims. It's facing Medicaid cuts by the government after the Big Beautiful Bill. The company is also facing constant public scrutiny, especially after the CEO of the United Healthcare Group was actually assassinated. So for United Health, let's talk about the fraud portion first. So they're being accused of Medicare fraud, and this is what the company actually said in May 15. So on May 15, they actually said that we have not been notified by the DOJ of the supposed criminal investigation reported without official attribution in the Wall Street Journal today. So that was what they said on May 15th. And currently now in July the 24th, the company actually proactively reached out to the DOJ after reviewing media reports about investigations into certain aspects of the company. The company has now begun complying with formal criminal and civil requests from the department. The company has full confidence in its practices and is committed to working cooperatively with the department throughout this process. So there's a bit of a mixed message here. So United Health actually previously said that they were not being investigated, but currently now the tone has swapped to them being investigated. We'll never know what the truth of that is until the actual settlement comes out. So if you're to draw parallels to Enron, this is what Enron said in their 8K. So this company Enron actually said that they'll be restating a lot of their different financial statements, and there was nothing wrong with the company. But soon after that, we know what happened. The company just went bankrupt, it collapsed. So for United Health, there's always the possibility there that the company is doing something behind the scenes that is bad for its shareholders. So the worst case for your fraud scenario is simply just $5 billion of fine. So that is around 20% of their total net income right now. That will not only bring in reputational damage, it will also lead to increased scrutiny, which means that United Health will be less likely to win their insurance in the future. So the potential repercussions could be extremely severe if United Health is found to be guilty. So besides that, you're seeing Medicaid cuts as well. So the Big Beautiful Bill is going to cut Medicaid by around 15%. So currently now for United Health, they have around 15% of total revenues coming in from Medicaid. So that will slightly affect United Health's revenue in total, especially when this Medicaid cut comes into effect in the next few quarters. So besides that, the company is also facing poor sentiment, which is supposedly one of the reasons to sell the stock. So before the stock actually dropped by 50%, everyone was talking about how United Health is basically the biggest and the greatest defensive juggernaut in the entire stock market. So the stock was just grinding up and up and up and up, all the way until all-time highs in 2024. And then after that, when the stock dropped 50%, apparently it's time to sell again. So the stock is falling, so you shouldn't be buying the stock. That's what the streets are saying right now. So we have to see if the management is able to deliver and rescue this stock price today. So there's some positive that I would like to highlight about the business as well. So the first one is the CEO, Stephen Hemsley. So Stephen Hemsley actually became the president and chief operating officer in 1999. And in 2006, he was appointed as CEO of the company. So he brought the company from 2006 all the way to 2017. He brought the company through your 2008 crisis. He brought the company through your ACA implementation. And he also brought the company through expansion of Optum as well. In fact, he was the one that pushed for the expansion of Optum, which now accounts for around 50% of the total net income for United Health. So for Hemsley, he is clearly one of the top CEOs in your entire healthcare insurance space. And that's why the company brought him back in, especially when the company was facing strong headwinds in the last quarter. So besides that, Stephen Hemsley also has skin in the game. So he has a one-time $60 million stock option grant in 3 years' time, meaning to say if he remains CEO for 3 years, then he'll get his stock. So it is in his best incentive, it is in his best interest to basically rescue the company and bring it back up to all-time highs. And besides that, Stephen Hemsley's personal portfolio and his personal net worth is also highly dependent on United Healthcare stock. So he owns around 374,000 United Healthcare stock, and that accounts for around 1/3 of his total net worth. So you can definitely say that he has skin in the game. He's definitely incentivized to push the company and make the company great again, like what it was before this year, like what it was in the past few years. So for Hemsley, he has been buying the stock as well. So in May of this year, he actually bought around 25 million worth of stock in one single portion. So your insiders, they sell for many different reasons, but there is only one reason why they will buy the stock, which is that the stock is undervalued, and he clearly thinks so as well. So for United Healthcare's valuation, the company now is trading at an 11 times PE multiple. So historically, over the past 10 years, the company has never traded at this low valuation. In fact, the lowest point that it got to was around 15 times earnings in around 2019 or so, when the healthcare insurance space was correcting. So for United Health, you're buying a company today that is at its historical low valuation. So I think at today's valuation, it is providing a decent buying opportunity. So for the next few quarters as well, United Health is basically priced for around 30% decrease in its EPS. So they're projected to have around $20 worth of GAAP EPS for this year. So with expectations tempered, you could definitely see United Healthcare basically explode to the upside if the company report matches their earnings, or if the company is able to beat its earnings. So this is another example of a fraud case in the past where Warren Buffett bought into the company. Warren Buffett actually bought into the company when the company was facing some form of fraud issue. So over here it says, filing shows Berkshire bought HCA shares. So HCA actually had the largest healthcare fraud case in US history, and they settled for around $1.7 billion. And despite that, Warren Buffett bought into the company, and there could be a possibility that Warren Buffett actually bought into United Healthcare as well. So this is United Healthcare's fair value. So assuming an $18 EPS, so the streets are expecting around $20. Let's say if it goes down even more, it goes down to around $18 worth of EPS. Assuming a 18 times PE for this company, historically the company trades at between 15 and 20 times earnings. In fact, over the past 5 years, the mean has been around 20 times. So at its current price today of around $285 a share, United Health will give you around a 15% CAGR. So I think at today's price, United Health is quite attractive. It is a company that is risky, of course, but if you're willing to ride it out and if you're willing to hold this company for the long term, then I think the company today is presenting a decent opportunity. So for United Health, if you have to look at its fundamentals as well, historically, this company has been a compounder. I mean, the fundamentals for this company has been just up and up and up almost every single year, apart from this year when they had a cybersecurity issue. So when you have a company that has decent track record like United Health, you could definitely expect something similar in the future as well, especially with Hemsley back in charge. So next portion, I'll be talking about my stocks and how my stocks are overvalued. So first of all, what you need to understand is that in the long term, your earnings bring the greatest returns. So this is actually the S&P 500 since around 1989. So your multiple expansion has actually brought around 2.6% growth only. Your earnings growth has brought around 7%, and dividends is around 2%. So over the long run, most of your stock returns, most of your stock price returns actually comes from earnings growth rather than multiple expansion. So for reference, this is my portfolio as well. So I've been seeing some comments about my portfolio saying that a lot of the stocks in here are expensive. So they're highlighting how S&P Global is at 40 times earnings, how Amazon is at 40 times earnings, how MSCI is at 35 times earnings. But what you need to understand is that for all these companies here, they have a predictable runway of growth. So when you have a company that is able to grow its earnings, like for example Moody's at 10% over the past I think 50 years or so, then you have an extremely strong company there. And for its PE multiple as well, there's something called a justified PE ratio. So when you have a company that is not only able to increase its growth and maintain high levels of growth rate, so when you have a company that is able to maintain high levels of growth rate and maintain high ROIC as well, which is what a lot of my companies over here have, then your justified PE ratio is actually a lot higher than the normal S&P 500 company. And so if you were to look into Moody's, for example, Moody's has an ROIC of upwards of 20% and it has growth of around 10% or so. So minimally, Moody's justified PE ratio should be around a 40 times earnings. And so a high valuation for a quality company could seem cheap after all, because people often underestimate the predictability of these earnings and how long the earnings growth for all these different companies can last. So besides that, this is from Aswaf Damodaran, is the NYU lecturer there. So this is what he actually came out with. So when your ROE on investments, basically your return on equity on investments is high, and when your expected growth rate is high as well, as you can see, the companies with the greatest ROE and the greatest growth rate deserves the highest multiple. So for a lot of the stocks in a company, they have predictable earnings, and I expect them to continue having those predictable earnings in the future. And when you're able to do that, especially when you're calculating your DCF, the terminal growth rate for all these businesses will be actually a lot higher than expected, meaning to say the company has the ability to continue growing and defend its market share. So a lot of them could seem overvalued based on a P ratio itself, but if you're to dig deeper, these companies could look fair value or undervalued after all. Last portion, I'll be covering some questions left in the comment section. So the first one, it says, just choosing United Health over all other beaten down healthcare stocks because it is the biggest and most diversified is amateurish mindset. Google was easy to make money as everyone is investing in it. Even a 90-year-old grandma invests in Google. You want to make big money, learn how to find the next Carvana, which could be a Canteen, or a Molina you are ignoring. So for every Carvana, there's a check. For every Palantir, there's another company that probably went down 80-90% that no one talks about because no one likes talking about losing money. So for my own personal investing strategy, I prefer to find high quality predictable businesses. I don't chase for highest returns. What I chase for is predictability. So in your healthcare insurance space, I view United Health as the most predictable one out there. And that's why I have some money in United Health. As for Canteen, Molina, I think Canteen is a decent company today. But to link Canteen to Carvana is a bit overstretched. And the claim that Google was easy to make money as everyone invests in it is a bit of a sweeping statement as well. I mean, if it was that easy for you to make money in the stock market, then you wouldn't have seen the April dip that we just had. You wouldn't have seen the 2022 dip. So I avoid this. I don't like investing in speculative stocks like Carvana, for example. I mean, Carvana was a company that was unprofitable, and now it's a speculative hype stock. I don't like chasing for the highest returns. I like chasing for predictable companies that will give me incremental amounts of growth, incremental returns over time. And for me in the healthcare insurance space, the safest bet is simply just to buy United Health. The next comment, it says, nice video, what is your opinion on Prada as well as Lululemon? So for me, I think Lululemon is a company that is slowing down in terms of its growth, but it is definitely undervalued. As for Prada, I view it as cheap luxury. So you have your luxury tiers. The ones highest up there will be Ferrari as well as Hermes. And then after that, it will be Richemont, followed by LVMH. And then the third segment, which is the cheap luxury, will be in your Prada and your Coach and so on. So for all these different cheap luxury companies, they'll be heavily impacted whenever there's a consumer depression, whenever you see a cyclical downturn. And so for me, I think Prada is not a company that I'll be interested in. I think a company that looks more interesting right now is LVMH. I hope you guys have found this one useful and invest safe.